Hey, this is David Olson. This is your free Money Master the Game review. Today we're going to continue talking about chapter 5.4 in Tony Robbins' new book, Money Master the Game, where Tony is talking about the different types of annuities. He talked about the fixed annuity, fixed indexed annuity, the hybrid annuity, which we said in yesterday's video doesn't really exist, and also the variable annuity. We finished by talking about all of these, but today I want to spend just a little bit of time, a couple of minutes, and tell you some of the large misconceptions and misunderstandings that people have about annuities in general, specifically the fixed index annuity and the lifetime income rider. Now, Tony talks a lot in the book. He's a big fan of this product, and he's right. There's a lot of good reasons to like this, and applied properly and for the right person in the right situation, it can be a lifesaver. It can give you that guaranteed lifetime income that you can't get too many places in the financial world today. But there are some misconceptions, there's some misunderstandings. So let's go through a few of those. For a complete detail of all these things, I encourage you to read my blog, and also underneath the blog there's going to be an opportunity to get a handout sheet that describes some of the things that we're talking about free of charge to you. So let's start with the most common one. The income rider, the lifetime income rider, is just that. It's not a base part of the policy, it's a rider you attach to the policy. The most important thing to understand about this, it is not a cash column. It is not real money in the sense that you can ever take out a lump sum withdrawal or distribution from this. It can only be used to factor and formulate the lifetime income amount that you're going to get should you decide to turn that on. This is probably the single largest misconception people have. It can grow based on the policy. It can grow greater than the underlying accumulation account. Now, an accumulation account is a cash account. It's the real money that you have available to you for a lifetime, rather for a lump sum withdrawal as opposed to a lifetime withdrawal. So the accumulation account is going to be in a fixed index annuity based on the index it's tied to. The income account is going to be based on a fixed percentage that the insurance company contractually is obligated to pay you for up to 20 years until you turn that income stream on. So that's the first big misconception. Probably the second largest misconception, that is, if you take money out of your account before you turn on that lifetime income withdrawal, it's going to adversely affect the amount of money that you can get out, basically dollar for dollar. So these products are wonderful products if they're used right, and to use them right, they really have to be dedicated to lifetime income. They have to be left alone as long as possible, let that money compound and grow on a guaranteed basis until such a time that you want to start the withdrawals. Probably the third largest misconception out there is the way in which these products credit. They can be very complicated, and even the folks that are selling them to you sometimes don't fully understand all of the parameters. But here's a good example. Instead of just being tied solely to, say, the S&P 500, many products today will put a portion of your money into a fixed income column, a fixed interest rate column, and they'll put a portion of it in the index column. So for instance, say today's low interest environment rate, you get 1% on half of your money, and then you get the market on the other half. But you don't get the full market because there's usually caps or there's spread, something that's going to reduce that. So for instance, if it's 1% on the fixed side, you're going to get a 0.5% for that half of your money total. If the market does, say, 10% return and you have a 1.5% spread, and we'll talk about those more in the body of the post and also in the free handouts you can request, then you're only going to get credited half of 8.5%, which is 4.25%. So half your money earns 4.25%, half earns 0.5%. You're going to earn for that year 4.75%. Not a bad rate of return for a safe investment compared to, say, a CD or a money market account, but it's certainly not capturing the majority of the market, as oftentimes people are told when they purchase these products. So again, I encourage you to stick around, read the rest of the column for a little bit more detail, and by all means request the free handout sheet that will talk a little bit more about some of the other misconceptions. And this has been the free Money Master the Game review by Tony Robbins. Thanks a lot, folks. Take care.